As we start this week 5, I want you to take a few minutes, pause this video, and answer the review questions I have here. See how much you have actually comprehended from our past meeting, as well as doing the payroll example below. After you've completed as much as you can, go ahead and resume this video, and we're going to go through the answers. All right, so the answers for this review list at least 3 fringe benefits. There were 7 or 8 that we had mentioned in our previous video and in my notes. Those would include items such as reduced or free education and not having to pay taxes on it, no matter if you either at an educational institution or not an educational. Your employer could give you money if you're not at an educational institution, and that money be used for your schooling, and that is a non-taxable benefit, fringe benefit. A couple others, you could have no additional cost services that your employer provides, like taking a free trip on Southwest Airlines if you worked for Southwest Airlines. Other items such as employee discounts, de minimis benefits. You remember the de minimis? Those were the small benefits that are hard to keep track of, like personal use of a cell phone. But the employer paying into a 401k plan for you or paying in for medical premiums, those you're not taxed on for those benefits. So those were quite a few of the ones that we looked at. Number 2, what payroll deduction is taken for federal withholding but not FICA? And that would be your 401k or your retirement option. So for 401k retirement options, the money is taken out for federal withholding purposes. You're not taxed on it, but you are taxed for FICA. List 3 specific employer payments that are not taxed. So those could be payments into your medical premiums, payments to your 401k. Those are actually taxed later on. Payments that are going to be reimbursed to you that you get ahead of time, those are not taxed. Who pays federal withholding taxes? Hopefully you know that that's the employee only. The employer does not share in that. Which form is filed quarterly for FICA and federal withholdings? That would be Form 941. When are FICA and federal withholding deposits made? Remember that was back 2 weeks ago. They are made typically one of 2 times, monthly or biweekly. Are wages received from workman's comp tax? And the answer is no. If you are hurt on the job, then your pay that you receive is not taxed. Are wages from unemployment tax? And the answer is yes. If you receive unemployment, you are taxed on that. So those 2 are commonly, that's why I put them in here, they are commonly mixed up, or both of them not taxed, but that's not true. Unemployment is taxed. Which payroll deduction has a use it or lose it? And that would be your flexible spending account. Your FSA has a use it or lose it. What are the 2 typical amounts allowed to be deducted for an IRA contribution? So that depends on your age. So the 2 typical amounts, they've just went up in this past year. They are $6,000 and $7,000 for those 50 and older. What is the IRA phase-out range for someone with no company 401k opportunity? This one's kind of a trick question. I don't expect you to memorize the phase-out ranges. I will give those to you, but you need to know that if someone has no 401k option, there is no phase-out limit. They can contribute and deduct to an IRA no matter how much they make. Which form is used to determine how much federal withholding should be deducted from each pay period? And that would be when the employee fills out their Form W-4. Writing exempt on line 7 of the form mentioned above, the W-4, what will that do? That will tell the employer not to withhold any federal income tax from your pay. For federal withholding purposes, retirement companies will default to this filing in number of allowances unless otherwise specified, and that would be they default to married with 3 allowances. So that could be way too high for somebody who is single living alone. They may not have enough taken out of their paycheck. They would want to file that W-4P. The marginal tax rate means what? That simply means how much tax are you going to be paid on the next dollar that you're earned. It's not how much tax are you paid on all money that you've earned. It's just on that next dollar because your early dollars are taxed at a lower percentage. How many marginal rates are currently used in the U.S.? The answer is 7. They go from at the low end 10 and then up a little bit to 12, and then they go on up to 37. What is the difference between a marginal rate and an average rate? The marginal rate is how much you're going to be taxed on the next dollar. The average is what you're taxed on in average on all of it. So even the lower amounts are added in. The average rate is going to almost always be lower, if not the same in a few situations, but never higher. Okay, I did a kind of a complex, from what we've done so far, payroll example. So hopefully you have this as well completed. If not, go ahead and pause and finish this one as well, and then we're going to go through the answers here in just a few seconds. Okay, so with this one, we're going to need to have our federal charts up to see how much taxes to take out for federal income tax. We're looking at 3 allowances. Semi-monthly is our pay period. Married, those are going to be our important items for the federal. We've currently have made $129,600. That automatically should raise a red flag that I'm getting really close to the Social Security limit of $7,000. With our next check of being $7,000, I'm going to most likely go over it unless my deductions take me well under, which the deductions wouldn't be that high. So we would have to go through and figure out what is my taxable income for not only federal income tax, but Social Security and Medicare. It's going to be 3 different amounts because I've hit the cap. So let's look at those. So for Social Security, I first want to figure out how much of the $7,000 is taxable just to make sure it's not a whole lot lower. It takes me down to like $2,000, but it shouldn't. I would have to have a whole lot of deductions. But no, I only need to take out the 2 items, the $150 to the HSA and the $200 for the medical premiums. So that puts me at $66.50 being taxed. If I add that to my previous $129, I go well over the limit. So all I need to do is figure out what is left to get me to the tax limit for Social Security. So I take the $132.9, the tax cap, minus what I've already made. And that tells me only $3,300 is left to be taxed for Social Security. So I'm going to keep that in mind. Medicare, there is no cap, so it's the same as the $66.50 up here. Federal withholding, everything's the same, except you get to take out 1 extra deduction, and that's the 401k amount that's put aside. So we're going to look up $6,300 in our tax tables here in a few minutes. All right, now I just did a real basic, instead of doing it in Excel, I put it all right here so we could easily see it. Gross wages, $7,000. When you multiply the Social Security, the $3,300 at 6.2%, we get this. Medicare at 1.45. Federal withholdings, I put the calculation down here. The guy is in the 22nd bracket, 22 percentile. And then we take out his premium, his HSA, 401k, and extra charity, and he's left with a net check of just over $5,000. Finally, I want to do the journal entry. The journal entry should mirror everything I have up here, just putting it in accounting terms and into the appropriate account. The part 2 shows how much the employer pays for payroll tax. They're paying the Social Security and the Medicare the same amount that the employee did. And then on this one, I included, and I put everything into one debit. You wouldn't have had to. You could have put a 401k expense. You could have put a separate expense for medical premiums and life insurance. I just put this time, just to show you that it can be done a little bit differently, I put it all into one benefit plan expense. Added them all up, the 3 of them, and then taking each one and putting it into their liability account to know that I owe money into those accounts. All right, so that's it for our review. Let's now go into our new material. So the first new thing we're going to look at is the W-2 and exactly all the boxes and what that entails. All right, so you should definitely be sent this. The employer needs to send it out by January 31, and they're going to send it out to you if these two situations occur. The employer can apply for an extension. They try not to. They try to get it out because they know people want to file their taxes, but every once in a while some issues come up where they need to do that. All right, so let's start looking at the different items here. Box 1, it's going to list, note your federal taxable wages. And I'll even bold that and underline it. It's your taxable, not your gross. So nowhere on the W-2 does it list your actual gross wages. So you'll never, unless you don't have anything taken out, you won't see how much you actually made. You'll see how much is actually taxable, which is better for you because you want to have the lower number as being taxable as possible. Box 2, that's going to show how much you had taken out of your paycheck for federal income tax. This is the only amount that you are going to use on your 1040 at the end of the year to see if you get money back, to see if you paid enough into the system and that you get a refund with any other credits you may possibly get. Box 3 and 5 are almost always going to be the same. These are the Social Security and Medicare. The only difference between box 3 and 5 is if you hit the cap. Now notice here, the first thing is the different box 1, 3, and 5 for a lot of people will always be the same if you don't have any money put into a retirement account. As soon as you start putting money into a retirement account at your work, then box 3 and 5 will be different than box 1 because boxes 3 and 5 will be higher than box 1. Box 3 and 5 should never be lower, or I should say box 5 for sure, because you could hit the cap on box 3. Box 5 should never be lower than box 1. Keep that in mind. Now, boxes 3 and 5 usually will be the same, except now for this year in 2019, if you hit the cap of 132.9. At that point, it stops. Box 3 stops at 132.9. Box 5, it keeps going all the way up to show how much money you've actually have earned from Medicare because there is no cap. Now, boxes 4 and 6, you don't really use this in many of your calculations when you're doing your end of the year tax. The only way that it comes up is if you possibly overpaid into Social Security because the employer is going to show in box 4 whatever you made in box 3, they're going to multiply that by 6.2%. And in box 6 by the 1.45%. So if you have more than one job and together both of those jobs went over the cap, that's one of the ways that it could be beneficial that it's on there to show how much you paid into Social Security because you could have paid in too much. You could have went over the cap. It's 132.9 for all your wages, not just from one employer. Box 7, this is for tips that are reported usually as a server. Box 10, this one is set aside for if you put money into a daycare FSA plan, then that amount is put in there separately, and that's because of later 1040 calculations to see if you put in too much or not enough and how they calculate child dependent care credit. There's a lot of different things that happen, and that's why that one is specifically separated out to show how much money you've put away for your dependent child or children. Box 12, this is most commonly used for 401k retirement options, and the most common codes are D and E. If you see those on your W-2, you're going to see most likely one of these two items for your retirement that you put away. And that's how much, so you can have an idea of how much you put away, but it also tells the tax programs later on to when they calculate if you should get a retirement benefit credit, it's going to use that as well. DD is now a common code you'll find as well. This has really nothing to do with your tax return. It simply shows that your employer has contributed to your health premiums and how much, and to make sure that they have contributed the right amount based on the employer's size. Box 13, there's 3 boxes there. Basically, the main one is the retirement box. That's if your employer offers you a retirement plan. Remember back to the IRA we discussed a week or two ago, the retirement plans. If you have a retirement plan option at work, you're limited. So this will tell the tax preparer if you have that retirement plan or not. Even if you don't put into it, it still counts. All right, box 14, anything in there is not necessarily used for your tax return. That is for extra information. If your employer wants to put something in there, they do not have to. And then finally, your bottom 5 boxes, box 15 shows your state, and then 16, 17 show the state taxable amount and the state withholding, and then 18 and 19 show your county taxable amount, which is almost always, at least for Indiana, is the same as the state. So most of the time, your boxes 16 and 18 are going to be the same. Boxes 17, that's your state withholding, will be different than your county withholding amounts because the county doesn't withhold as much as the state. And then box 20 for Indiana shows which county you lived in. So it'll say 48 if you lived in Madison or 18 if you lived in Delaware, no matter where you worked. All right, so a W-2 example to kind of illustrate how this is going to work, and we're going to fill this out as we go. So let's work through this. How would you fill out a W-2 for someone with the following information? Okay, I give you their total wages, their gross wages, and then a couple of the items that are withheld through payroll deductions. So let's see how we would have calculated this. For box 1, your federal withholding, your federal income tax, how much is taxed? And I only ask you to do the first 3 boxes on this one. Yeah, fill in boxes 1, 3, and 5. So for box 1, you take your gross wage and you can subtract out your 401k and your medical premiums. Now for box 3, you can only subtract out your medical premiums. But if we do that, that leaves us with $136,000, which is over the cap. I have to stop at the Social Security cap. However, for box 5, I don't stop and I put in the full amount, the 136. So that's an example of where all 3 boxes could be different. Now for our next one, I want you to try this one. For the following, we're going to determine the boxes for box 1 through 12. And I tell you the annual salary. And the reason I tell you that he's paid semi-monthly is because to get box 2, you're going to have to turn this salary into what he would make on a semi-monthly basis. And then use that to figure up, actually, you're not going to use this salary. You're going to use this salary minus any of the necessary withholdings first. Then you're going to divide that by 24 pays, because there's 24 pays in semi-monthly payments plan. You divide that out to figure out what is his taxable amount every paycheck, and then look that up in our charts. So what I want you to do is pause at this time and try your best to fill out all the boxes, at least 1 through 12. And let's see what you get, and let's see how you do compared to what my answers are. So take a few minutes at this point. Okay, let's look at how you did. So for box 1, we don't have to separate this out yet. It's only when we get to box 2 that we need to break it down a little further. So box 1, we're simply going to figure out what is taxable for federal income tax. So we can subtract out our medical premiums. We can subtract out our 401k retirement option. We can subtract out our flexible spending for dependent care and for medical flexible spending. We do not subtract out any child support. That is considered taxable. We don't get the deduction for that. So the amount that I would show in box 1 is $43,000. I'm going to use that $43,000 now to continue with box 2. So the first thing I'm going to do is I'm going to break the $43,000 down into 24 pays. So that tells me that every paycheck I have taxable $1,791. Now I'm going to want to look that number up in the semi-monthly chart for somebody that is married with 3 exemptions or 3 allowances. Okay, so if we do that, all right, so what I did, and this is kind of backwards. I'll put this one below. All right, here we go. Take the 1791 minus what it says in my charts, minus the 481, and then take that number. He's in the lowest marginal bracket of 10%. So every paycheck he has taken out 131, but nope, that's every paycheck, not for the whole year. So then what I have to do is take the 131 and multiply it back out over 24 checks, and that'll tell me how much is taken out of his paycheck for federal withholdings. And you can see that that is less than 10%. Even though his marginal rate is 10%, he's not really paying an average rate of 10%. He's really paying, just to give us a quick, just over 7%, 7.3% would be his average rate. Okay, for box 3, it's going to be almost identical to box 1, except this guy is taken out. We are not allowed to keep the 4,000 in, so it's removed. So the amount that is taxable is 4,000 higher than what box 1 was. Box 4, that's very simple. Just take whatever box 3 is, multiply it by 6.2%. Box 5 is going to be the exact same as box 3, as long as no cap was hit, and the cap is not hit here. We did not make 132,900. So we come down to box 5, and it's the same, 47. Box 6, we simply multiply that 47,000 by the Medicare rate, 1.45%. Now, box 10, I told us that he had $1,500 taken out for flexible spending dependent daycare. So that's why that is separated out here. And that would be used in calculating for tax purposes later on. He would have a code D in box 12 to show how much was put into his retirement plan. And then a code DD to show that his employer had paid on his behalf $5,500 of medical premiums. So that's how you would have filled out the W-2 for this example. Now, I do have a separate example in the practice. If you go into the IVY Learn with my notes, there is another example there that you can practice with, and I have the answers posted as well down below in that week's module. All right, a few other forms that we want to go over. So we just did the W-2. The other form that's very similar that you probably have never even seen before is called a W-3. The W-3 is a summary form of all the wages of all the employees of that company, and it's only sent to the IRS. So that's why you would have probably never have seen it before. It's going to be a summary of all the boxes 1 through 6, on the W-3. It's just a summary form. That's all it is. And notice here that it's due at the end of February. So some other important returns that you're going to find if you're dealing with payroll potentially. The Form 1099 miscellaneous. This is a very common form, and this is when contractors receive these from companies. They're given to those who are not employees, who are considered independent contractors. And we went over some of those rules. Who was an independent contractor way back in week 1. Notice the 1099 miscellaneous is also given for other things, not just independent contractors. So if you win money in a prize, but if you win money at a casino or a lottery, you're given what's called a W-2G. And then a few other forms that you normally will get that goes on a tax return, 1099 div or interest. 1099-R shows how much you received from retirement every year. 1098-T, this form is kind of being revamped a little bit, but as of this current video, it's still not a good form to use. You always want to go and look at your actual tuition and see how much you have paid versus how much was paid through scholarships for that year. The 1098-T doesn't always do that and do a very good job of it. We go into more detail in tax class on that. The final form that I wanted you to be aware of is a 1096. It's very similar to a W-3. It's like a summary form, but it's a summary form for each 1099 that you do. So if you do a 1099 miscellaneous, if you do 3 or 4 of them, then you're going to file one 1096 for that 1099 miscellaneous. And then you're going to do the same if you file 1099-R. You're going to file another 1096 and mark on there that you're doing that for the R category. All right, now we're gonna go into the state income tax and county income tax, and we're gonna focus on Indiana since that's where most of you will live and work. One thing that I want you to memorize is what the Indiana rate is. I think that's important. It doesn't change that much, and it doesn't change. When it does change, it changes very little. It doesn't change every year by any means, maybe every 5 or 10 years. So I want you to memorize this 3.23%. So when I give you a problem, I'm not going to tell you what the Indiana rate is. I'm just going to expect you to know it. Now that it's not the case with the county, but we'll go through the counties here in a few minutes. Notice here that state income tax and county tax are different in that how they and where they are taxed. States, they tax you on where the services are performed. So even though you live in Indiana, but you may work part of the time in California for a couple months every year, you are going to be taxed at both Indiana and California. You're taxed on where the services are performed, not just where you live. However, Indiana counties are different. Indiana counties, you're taxed on where you live, not necessarily where you work. So you could live in Kokomo, but drive to Indianapolis, and you're going to be taxed at the Howard County rate of Kokomo, not Marion County for Indianapolis. We'll get into more of that in just a second, but I wanted to mention here that there are 9 states that actually don't have any income tax at all. And you can see these 9. 2 of them are even more unique, and I won't mention which ones yet, but of 2 of them, they don't have sales tax either. They don't have state or sales tax. It's kind of a weird combination. And your discussion board for this week deals with this. And I'll leave it at that. And you can go through and figure out if they don't collect sales tax, or in this case, income tax, how do they make up their money? Because Indiana, through Indiana sales tax and income tax, that's over 75% of where the General Assembly gets its money from. So how do these states make it up otherwise? I think that's an interesting thing to look up. All right, so what if someone lives in Gary, going back now to where the services are performed. If someone lives in Gary but works in Chicago, how does that person get taxed? Well, a lot of times states have a reciprocal agreement, which means you're only taxed in the state that you live because they don't want to burden you too much. And so Indiana has a reciprocal agreement with these states down here. So Indiana and these states have come to an agreement and says, even though you may live in South Bend, but you work just across the border in Michigan, Michigan's not going to tax you. Indiana's just going to tax you. Just the same if it was the other way around. If you live just on the Michigan border, but you work in South Bend, just Michigan is going to tax you, not Indiana, because that's where you work, where that would normally be the rules. However, you'll notice that Indiana, the one state that doesn't touch us, or that does touch us that's not on here, is Illinois. Illinois stepped back and found that they were losing money. And that's simply because of that case I put just above. Chicago is such a huge city just across the border that a lot of people live in Indiana but work in Chicago. There isn't the same situation going in reverse. So Illinois was actually losing money. They had more people working in Illinois than the other way around, Illinois people working in Indiana. And so for most of these states, they considered it a wash. So there would be an equal sized city on either side of the border. So like Evansville for Kentucky versus Louisville for Indiana, kind of equal sized, potentially sized cities. Cincinnati and Fort Wayne for Ohio. People from Ohio come over to Fort Wayne. People from Indiana go to Cincinnati. It's probably an even split. But Illinois, they don't really have a comparable size as Chicago on the Indiana border. And so they were losing money. So they rescinded that agreement. In that case, if you are one of those, say you live in Lake County, you have to then file a non-resident return in Illinois, and you still file a return in your home state in Indiana. Now you get a deduction for the amount that you paid in your non-resident state, but you still could have to pay some in Indiana as well. So you could have to file more than one state return. It's very likely that that could happen. Okay, so, and this especially happens, I put this just to highlight it. Professional athletes do this all the time. They work in potentially 20 states or more, because when they play their games, they play a certain number of games in each state when they travel, and the states definitely tax that. They consider that working in that state. So a professional baseball player could easily pay into 10, 15 different state income taxes and have to file that many state non-resident returns just because we don't have a reciprocal agreement with all of those states. So you can read through this and see how that works. I'm not going to read that to you. And then this little story that came out in an article about this pitcher of the Texas Rangers. Texas doesn't have any income tax, but yet he still has to file many, many state returns because of all the games that are played in each of the states. So I thought that was very interesting. And you can see how somewhere like California, the team or that state, since they have so many teams, they collected over $216 million in taxes from their professional players, professional athletes. They're not going to want to give that up. So that's why they tax them. The last thing I wanted to come to was the county tax. Big difference again is they tax you where you live. And I have provided to you in your notes section the county tax rate. I'm going to go ahead and open that here. And you can see what your county taxes are depending on where you live. Remember, it's where you live, not where you work. So some of the ones that most of you around here who are watching this will be in the Madison County area. So we're 1.75. Potentially you'll be in Delaware County, 1.5%. You'll see how the rates differ depending on your county, but they're somewhere usually between 1.5 up to about 2.5%. They can go a little higher or lower than that, but that's the average. You can see one county down here is really low. It's only 0.7%. Whereas another county, I have to think about it for a second, but it's pretty high. It's over 3% or near 3%. I don't see it right. Oh, here it is. Jennings County. And that's a big difference between Jennings and Jefferson. Jefferson is only 0.3%, while Jennings County is 3.1%. That's really high. There's a couple others that are high as well, that are up in the higher twos. And you may want to look through and see what your county rate is. Okay, with that, we are going to end this first part of the lecture. And the second part, I think you'll find really interesting. I go into what's called the flat tax or the fair tax. More appropriately, it's called the fair tax. And you'll get an idea of what that really is. And I think it's, you may have heard little bits and pieces, but we kind of go in through it in detail in our next lesson.